Excellent. Okay, thank you. Happy to do that. So, as Ryan said, we've just completed a major report on the Canadian REIT sector. And several times throughout the year, what we'll do at Keystone is we'll target a specific industry or theme, and we'll do a sector report, which essentially involves looking at and performing financial statement analysis and other forms of fundamental analysis on every company in that industry, gauging the different growth prospects, and then providing potentially some recommendations as well as some top tier monitor list companies. So we just completed this for the Canadian REIT sector, our 2024 Canadian REIT report. And what we essentially do is we learn a lot about what's going on in the industry when we conduct these reports. So for Canadian REITs, what I want to focus on here, just some of the facts and the statistics or the information that we've been able to gather in terms of the current state of the market and what investors who are looking at investing in REITs are essentially investing in right now. So the Canadian REIT sector consists of 40 individual stocks. The total market value is about 70 billion of the entire sector, and then the average REIT in the sector is about 1.7 billion. The largest category are the residential or apartment REITs. There's 12 of these, and the smallest category is the industrial REITs with only 3 members. 11 out of the 40 REITs increased their distributions over the last year. And the largest increase was from Boardwalk Apartment REIT, which has been under coverage since 2021. And that increase was 22%. 5 REITs eliminated their distributions over the last year. And one of the REITs did a distribution reduction of over 50%. In terms of valuation, the average price to FFO or cash flow is 12 times across the entire sector. Residential REITs are the most expensive on average with a valuation multiple of 15 times. And then the average yield is just under 6%, 5.8%, with an average payout ratio of 67%. So why don't we just talk about what REITs are? So REITs are companies that own income producing properties. So they're landlords. They might own shopping malls, office, apartment complexes, industrial buildings. And typically publicly traded REITs that can be public or private, but the incentive that investors have would be a high yield, a high income yield by investing in one of the REITs. Now, REITs have a special tax structure. They avoid paying corporate income tax if they distribute at least 90% of their taxable income to unit holders. So it's tax advantaged in that way. Unit holders, on the other hand, they will pay tax on those income distributions at the full rate for regular income. So this would be similar to interest income from a bond or GIC, and this is a higher rate than eligible corporate dividends. So one of the first ways that we look at REITs is REITs can be divided into different categories, and it's really important to understand the categories because each one will have different growth opportunities and risks associated with them. So residential REITs, this is the largest category. These are apartments, some mobile home communities. Generally speaking, we like the residential REIT space because residential apartments are generally considered to be a defensive asset, even regardless of what's happening with the economy. People need a place to live, so there is a defensive nature to that segment. And as well, residential REITs do generally trade at a premium valuation relative to the others, but good, strong fundamentals in certain regions in that segment. Then there's the retail REITs. So these might be shopping malls, other types of retail operations. Now, retail REITs have struggled somewhat over the last several years. They can be more economically sensitive, but then also there are trends like e-commerce that are driving people out of the shopping malls. Diversified REITs. So these are REITs that have exposure to different categories. Usually they're retail and office REITs primarily. And then office REITs. These are, of course, office buildings. Now, the office space has generally not performed great recently, because again, they can also be economically sensitive. But recently there's the work from home trend that has been impacting the office space. So higher vacancies in the office category post-pandemic than we saw pre-pandemic. Industrials, this is a small space, only 3 companies, but these can be warehouses, distribution facilities. Well, these REITs can be economically exposed. Industrial properties, particularly in key markets, have been benefiting from strong fundamentals and very strong rental growth. And then specialty REITs basically would be anything that falls into another category. So some of the key financial metrics that we look at specifically when we're analyzing REITs, FFO and AFFO per unit. So these are REIT terms, but this is basically cash flow and free cash flow per unit. And we're really looking for that per unit growth because this is what generates value creation for investors. A lot of REITs in Canada particularly are very good at growing their overall revenue, their overall cash flow, but on a per unit basis, there's no growth, and that's not going to provide value long term. Same property net operating income growth. So this really measures the performance of the existing portfolio. Are the rents increasing? Are there good fundamentals there? Payout ratio, how much of their cash flow are they paying out to maintain their dividends? So if we're looking at FFO, we're targeting payout ratios less than 80%. Debt to assets, so analyzing the debt leverage. Debt to assets or gross book value, generally we're targeting less than 50%. Anything above 60 generally signals higher leverage. There's the interest coverage. So we're targeting a multiple here. This is another debt leverage ratio. We're targeting a multiple above 2.5 times. Anything below 2, again, we would say is higher leverage. Distribution growth, we don't have a target in terms of the company growing its distribution, but we do favor REITs that are able to maintain consistent distribution growth. And this is only about a quarter of the sector. 11 companies out of 40 last year that increased their distributions. And then, of course, there's valuation. We would look one of the metrics we would look at here: price to FFO or price to cash flow, looking for reasonable valuations based on the underlying fundamentals. So just looking at the REIT sector performance, this is a 5-year chart. What we've really seen is we've seen some negative volatility over the past couple of years. 2022 and 2023, the sector's down about 21% on average. This year to date, it's moved up about 5% or 4 to 5%. But just over the last couple of weeks, or last month or so, it's come up about 17%. And a lot of what's been impacting REITs over the last couple of years has been the higher interest rate environment. So REITs are considered to be interest rate sensitive securities. They are negatively impacted by higher interest rates, generally speaking. So how do rates have an impact on REITs? Well, one, higher interest rates mean higher bond yields and rates on GICs, and these compete with other high dividend yield companies like REITs. So when an investor is deciding, say 3 years ago, whether or not to invest in a REIT or a GIC, GICs are paying about 0% back then. So it makes REITs look more attractive. A year ago, GIC rates were over 5%, which drives a lot of capital away from high dividend yield stocks. Reduced valuation, so higher interest rates, the way that the pricing estimation models work, this drives asset valuations down, and it also compresses valuations in the market. So whereas a couple of years ago, REITs may have been trading on an average of 15 times cash flow, now they're trading at an average of 12 times. It can mean also increased interest expense. Most REITs have their debt based on fixed rates, but as that debt matures, they need to refinance it, and they will need to refinance that at a higher rate, likely. Now, this takes a while. This is a gradual process. So it's not an immediate impact, but most investors are looking forward and factoring this into the decision of whether or not to invest. And then also reduce discretionary spending from tenants. So particularly if you're in the office or in the retail space, those are more economically sensitive areas. So higher rates mean less spending from tenants. Maybe some businesses aren't going to do expansion plans that would have benefited the REIT as well. So these are how interest rates will impact REITs. And as interest rates have been going up over the last couple of years, we've seen the sector valuations compress and prices on average come down. Now, just recently, we've seen 2 Bank of Canada rate reductions. That's expected to continue probably at least until 2025. The US Fed is expected to follow suit. So there is potential looking ahead that as interest rates start to decline, that this dynamic will reverse and it will actually be a beneficial environment to REITs. And this is likely part of the reason why REITs have come up in price over the last month on average. So this is the reason why we we conducted this research at this time. We feel that, it's an important time for investors to look at some of these interest rate sensitive sectors like REITs, utilities, other high yield dividend spaces, that in spite of strong fundamentals have not necessarily performed well over the last couple of years due to rising rates. And now there's potential for lower rates to essentially be a tailwind to these areas. So within the report, we have 5 companies that are currently recommended under coverage. We also have a top tier monitor list. So these are 6 companies that are of high value, relatively equal value to our recommended companies. They can be added or used as alternatives to recommended companies. So we have reports on those as well. And then we have our additional monitor list. This is 11 other REITs that are not likely to be added to our recommended coverage in the near term, but they do have strong fundamentals or value, or they're attractive in certain areas, and they could potentially be non-core positions in a portfolio. So anybody who this has been released to our income clients, and anybody who's interested in taking a look at the report can just reach out to us.
All right.
Perfect.
Excellent.
Something that I would like to note as well, just an FYI, if you're interested in this report, as well as attending our September 5th webinar, how to find the next 10x stock, attendees will receive that report as well. So if you register, you will be able to find that in your account. So just an FYI for anyone who is interested in both, because the REIT report is quite comprehensive. Not only will you get some good information in the webinar, you will also be able to review Aaron's top picks in the space.